Investing is one of the most effective ways to build long-term wealth, but putting all your money in a single asset or investment can expose you to significant risk. Market fluctuations, economic uncertainty, and unexpected events can quickly erode returns when a portfolio lacks balance. That is why diversification remains one of the fundamental principles of successful investments. And today on our Personal Finance and Wealth Building series, we explore what it means to build a diversified investment portfolio, why it matters, and how you can create an investment strategy that aligns with your financial goals, maybe risk appetite and investment horizon. This morning, we're joined by Oluwatobiloba Ojajuni, who is a financial analyst and investment educator. Thank you so much, Toby, for joining us.
Thank you very much for having me this morning, and it's a pleasure being here to be able to share knowledge in this aspect, and thank you very much.
Of course. So let's start this way. What is a diversified investment portfolio, and why is it considered a cornerstone of successful investing?
Okay, so when we talk about diversified portfolio, we're actually talking about a collection of assets that do not move all in the same direction or at the same time. You're looking at assets like when you're spreading your money across equities, fixed income, real estate, and mutual fund, and even sometimes commodities or dollar assets. And as a matter of fact, we ask people to build a diversified portfolio to avoid concentration risk when it comes to spreading their money. And this is essential in case of catastrophic loss that could come as a result of putting all your money in one asset. So for most people that want to build a diversified asset, it is necessary for them to spread across these different investments instruments that I've mentioned in likes of equities, fixed income. We also have the real estate, commodities, or even dollar assets. And this is essential to prevent against sudden losses that could come as a result of companies' problems or even a single event or policy change that could affect them putting their money in a single asset. So over time, a diversified portfolio, it's able to build wealth, and also it allows people to be able to manage risk properly. We're not saying the whole risk is going to be eliminated, but we are going to have a minimal risk and avoid putting all our investment into one single entity.
Okay, so I want you to talk to us more about the major asset classes that you mentioned earlier, why Nigerians should consider putting their monies or investments in these areas, and the one that can actually guarantee more ROI.
Okay, when it comes to these different asset classes, for a lot of people, they are probably hearing one investment instrument or one investment vehicle, and they are sometimes not able to understand what aspect of these investment vehicles are available to them. So we have the equities, right? These are the shares. These are shares that are listed on the exchange. And the way you make money through this is capital appreciation and dividend. And in real time, we've seen the reform confidence has boosted the Nigeria capital market reform. That's the stock market return over time. And we also have the likes of fixed income. Under fixed income, we have vehicles like we have treasury bills, we have commercial papers, we have federal government bond, and we also have money market instruments, and majorly for capital preservation and also for predictable income for people that are not looking towards putting themselves risk in equities. We also have other aspects like mutual funds. Mutual fund is a diversified portfolio of assets that are mixed together, right? We have maybe treasury bills in mutual funds. We can have commercial papers. We can have equities, depending on the categories. And mutual fund is good for individuals that they don't want to pick individual assets themselves. So maybe I don't want to pick equities myself. I don't want to pick treasury bills myself. I just want a professionally managed portfolio that are done by professionals. Then I'm going for mutual funds, which is another type of another type of asset class we can look at. We also have the dollar mutual funds, and we also have euro bonds too. These are also other type of asset vehicles that people can also put their money on, and this is to prevent against currency devaluation, and also as an edge against inflation in the economy. So these are different asset classes. And the other one also is commodities. Commodities in terms of gold or in terms of private equities. These are for people that can take higher risk, and they are also able to put a larger amount while waiting for waiting for higher returns in this aspect. So we have various diversified investment vehicles that people can put money into, ranging from equities, ranging from fixed income, ranging from mutual funds, ranging from commodities, dollar mutual funds, and euro bonds. And when you look at the dollar assets, we now have platforms now that even allow people to invest into assets like US stocks and all other aspects.
Okay, so let's wrap up this way, Toby. Is it possible and advisable that everyone or people who want to have some sort of investments in these portfolios can do all that? Can they put all their eggs in all these baskets at once?
Okay, so I would say it is not advisable for you to put all your egg in one basket, right? You can't say because, there are different asset classes that has been mentioned, then you want to go ahead to invest into these different asset classes. It doesn't work that way. So the best that you could do is that each asset classes are defined according to each individual's goals or what they are looking to achieve according to my risk tolerance or investment goal. Now, for example, if you are young and you are trying to invest into these asset classes, you might want to look at a mixture of maybe 3 or 4 that you're able to track over time, and you're able to get a real-time update on these assets without losing track of them, because it's very essential when you keep up with them, in the sense that we have market conditions that could affect, and you might need to be able to stay up to the trends and what is going on. So most often, if I'm young and I'm looking at starting into this investment vehicle, I cannot go and start picking everything at once. So I can select 3 or 4, maybe a mixture of money market fund and a mixture of, I had a mixture of fixed income, and I had a mixture of maybe dollar exposure. But for more people that are young, we're able to take risks. So you're looking at leaning towards equities more as a higher percentage, and a few of maybe a balance of real estate or money market fund with what you've taken with asset class. But for older people, you can't just have all these instruments. You look at what you're able to do towards safety and towards capital preservation or income preservation over time.
All right, thank you so much. I'm Oluwatobiloba, Ojajuni, financial analyst and investment educator. It's always good to learn 1 or 2 things when it comes to investments like this, so that one can know the one that is more lucrative, the one that has the most resilience, and that can give some sort of higher interest rates in terms of return. We hope to do this some other time. It was nice talking to you.
Thank you very much. And it's nice sharing this knowledge on this space.
Definitely.